So we are preparing to live stream on webinar. Yes, we are now live on YouTube. So almost 350 people have already joined. I think we'll cross 500 today. Fantastic. So good morning, everybody. And good morning, everybody. This is Brijesh Dalmia, and I am into personal finance for last 25 years. I welcome all of you to this webinar on a Sunday morning, 11 o'clock, with HDFC Mutual Fund, and we have Sresh Sahani, Zonal Head East for HDFC Mutual Fund. Big guy. He will also give some opinions about the power of debt fund. Thank you so much, all of you, for joining in. And let me tell you, this is a very special program, and all of you have been invited by some of the best mutual fund distributors in the country. Thank you so much, all the participants, to be here. And we will take 30 minutes into this presentation, not more. And then if you have any Q&A, we will answer those Q&A for 10 minutes to 15 minutes. So that is it. And so you can enjoy the rest of your Sunday. So let me start with a presentation on the power of debt funds, why it is a superior option than fixed deposit. And then after my presentation, Sresh will give a brief talk on the same, and then we can take your questions. All right. So I believe all of you are investing in mutual funds. सभी लोग mutual fund में invest करते हैं जो आज यहाँ आए हैं. और अगर आप mutual fund में invest नहीं करते हैं, then please make it a point to start your SIPs in mutual fund, invest your money which is lying in the bank in mutual funds. And this program is specifically for people who have fixed deposits in bank or companies, and why I believe that mutual fund debt funds are superior alternative to fixed deposits. Let us first understand why people invest in fixed deposits. The first reason is that they feel that the guarantee of principal is there. They have liquidity, they can withdraw their money at any point of time, and there is a guarantee of interest. All three are powerful reasons why people invest in FDs, and I agree with them. However, there is a problem with FDs. There are three major issues with FD. The first is that the returns are quite low. Penalty on early withdrawal. Some of the banks do not charge penalty, but then again, if you do an FD for 2 years and if you withdraw in 6 months, you get interest which was applicable for 6 months. And this is one major reason why debt funds are very, very powerful, because you don't have to define time period there. And lastly, it is not tax friendly. So if you are into the tax bracket of 20 or 30%, the entire interest is taxed except the minimum basic of 5,000 rupees as per the Government of India tax benefits. This is not tax friendly. This is the problem with fixed deposits. Let us now look why debt funds are a superior alternative to fixed deposits. And I have kept this program very, very crisp, very, very short, and you will enjoy it. My first point, friends, is the culture. Investing in debt fund is about culture. It's about a complete change in mindset. I will give you an example. When you start international travel, the first thing that you do is to travel through a tour operator in a group. And there are 40 people, 50 people, 200 people going in a group, and you are forced to wake up at 4 o'clock, 5 o'clock in the morning every day so that you can see that sunrise, or you can go to that tourist place, or you can take a bus ride or a train ride to see a site. Everything is predefined. You do not have any breathing space to decide what you want to do. And it is all right. We all started our journey like that. But after you have traveled 4 or 5 locations, after you have a little more flexibility, little more financial leverage, what people do is that they do not travel by tour operators. They make their independent travel plans so that they can sleep till 9 o'clock in the morning, which is not possible in case of a group tour. And you can take breakfast, lunch, dinner at your own preferred time. You can go to your own preferred places. You can do whatever you want. So it's a culture shift that happens in travel. In the same way, when you invest in fixed deposit, it is fine. There's nothing wrong with that. But investing in a debt fund is about a culture shift. You will understand this shift, the power of own travel as compared to a group tour travel only if you take your own travel. And once you start enjoying it, you will never go back to the tour operator for a group tour kind of thing, because the flexibility is not there. So the first thing is that you have to start this culture of investing in mutual funds and debt funds to understand the power of debt funds. Second point is flexibility of time horizon. When I say flexibility of time horizon, when you do a fixed deposit, you have to identify a period, 6 months, 1 year, 2 साल, 5 साल के लिए आपको एक फिक्स डिपॉजिट करते हैं जिसमें आपको एक पर्टिकुलर रेट ऑफ इंटरेस्ट मिलता है. म्यूचुअल फंड्स में खास बात क्या होती है, यू डू नॉट हैव टू आइडेंटिफाई द टाइम पीरियड. You can withdraw your money whenever you want, subject to certain exit loads and certain interest rate risk, which we'll talk about. But in case you think about investing for 3 years, and if you want your money in 2 years' time, there's no interest deducted in mutual funds. Whatever is the interest at that point of time or appreciation during that point of time, you get the entire money back. This is a huge advantage. Sometime when you do a fixed deposit of let's say 5 years and you need money in 4 years' time, you don't feel like breaking the fixed deposit, and then you have to explore other options. In mutual fund, you get complete flexibility that you can withdraw your money at any point of time you feel comfortable. You don't have to specify the time period. You have to give your money to the mutual fund house. Huge advantage. Third, tax efficient. Mutual fund comes under capital gains. So it's a reduced tax if you hold your investment for 3 years. When you go for fixed deposit, you are taxed whether you invest for 10 days or 10 years, the tax rates are same. You don't get any tax advantage, especially when you are in the higher tax bracket. So even if you are not in the higher tax bracket, you pay tax whatever is the tax rate, and in mutual fund also you pay tax whatever rates you are into that bracket. So there is no disadvantage of mutual funds when it comes to tax, but there are advantages if you are in the higher tax bracket. Again, it's about a cultural shift. Even if you are into 10, 15, 20% tax bracket, at some point of time, you will go into 20% and 30%, or maybe even more, 40% if you are investing in individual. To understand the power of tax benefit in mutual funds, you have to make a cultural shift in your mind that you have to start investing in debt funds so that in future, when your income increases and your tax liability increases, you understand the power of debt fund, and then you can take a call that you can increase your exposure. वरना क्या होता है, जब मौके पे आपको पैसे लगाने होते हैं तो आपको एक्सपीरियंस नहीं होता है डेट फंड का, अंडरस्टैंडिंग कम होती है, जिससे आपके बड़े डिसीजंस नहीं हो पाते हैं. तो यू शुड स्टार्ट नाउ. लेट अस अंडरस्टैंड द पावर ऑफ म्यूचुअल फंड्स एज कंपेयर टू फिक्स्ड डिपॉजिट. यहां अगर आप देखें, लेट मी, so you invest in 5 lakh rupees in both the cases for 5 years. Let us say the returns are same in both the cases, fixed deposit and mutual funds. So the maturity value or the redemption amount is same, 6,69,000. Interest on capital gain is 1,69,000. Here you do not get any tax advantage, indexation benefit. Here you are taxed at 1,69,000 rupees in fixed deposit, whereas in mutual funds you are taxed only for 60,000. In this case, you are taxed at 30% if you are in highest tax bracket, and here you are taxed only 20%. You pay 50,000 rupees tax on an income of 1,69,000, whereas in mutual fund you pay only 12,000 rupees tax on an income of 1,69,000. So your post-tax return in fixed deposit is 1,18,000 only, whereas in mutual fund it is 1,59,000. कहते हैं, if all things are same, the person who will benefit is person who will save more taxes. Here your net return is 4.34%, whereas in mutual funds it is 5.61%. This is just an illustration to show you the power of mutual funds. Another point, and I'm only 3-4 slides away, and then I will give you another fantastic perspective how you can use your fixed deposit in debt fund through a superior product also. Decent return. Now, in 3 months, 6 months, maybe your returns could be 0.2%, 0.5% less in mutual funds, because returns in mutual funds are not guaranteed. But if you see the last 5 years, 10 years, 15 years, and 20-year data of mutual fund, they have beaten fixed deposit returns in almost 90% of the years. So 9 out of 10 years, they will give you better returns than fixed deposits. So returns are also very superior when you compare fixed deposits, and you can talk to your mutual fund distributor and they will give you a chart. Certain special opportunities exist. This is very powerful, friend. Now, let us say equity markets are down by 20%, and you feel that markets have bottomed out and you want to invest some money in equity market, but you do not have any money in the bank account. Your 10 lakh rupees FD is there, which will mature after 1 year. What do? If you withdraw, you lose interest on that. And you mostly don't feel like breaking your fixed deposit in the middle of that. The mind doesn't work like that. Whereas when you have a debt fund, let's say with any mutual fund house, you can immediately switch that amount from a debt fund to an equity fund, taking advantage of falling markets. Now, these are very high opportunities. Suppose you need funds for 20 days time or 1 month time, and you don't want to break your fixed deposit, and the fund will come back in 20 days. In mutual funds, you can withdraw that money, use it for 1 month, and you can again, when the money comes back, reinvest in mutual fund and nothing changes. Whereas in fixed deposit, you have to take too many decisions of losing interest rate or breaking the FD. A lot of issues are there. So when you have debt funds, it gives you flexibility, the muscle of flexibility to do what you want. When you decide to invest in a debt mutual fund, it is not so that you have to stay with it for 6 months, 6 years, or 60 years. You can change the moment you want it. It is completely kind of liquid. Risk diversification. There is no risk in bank, I believe so. But then again, if you talk theoretically, mutual fund debt funds probably are more diversified as compared to bank. Any bank may not default, but the mutual fund debt scheme of that bank may provide you more diversification. For example, when you do a 5 lakh FD, you are taking 5 lakh rupees risk in that bank because you have given money to the bank. Whereas when you give 5 lakh rupees to a mutual fund debt fund, they invest that 5 lakh across 50, 70, 80 securities. Just to give you an example, this is a typical live actual portfolio of a debt mutual fund. I've taken the top 5 schemes in which they have invested. When you invest 5 lakh rupees in this scheme, 40,000 rupees goes into Government of India bonds, 30,000 rupees goes into Axis Bank, 25,000 rupees goes into National Bank of Agriculture, 20,000 goes into LIC Housing Finance, and around 18,000 goes into L&T Metro, and so on and so forth. So the risk is completely diversified. God forbid if any of these companies or any other company defaults or there is a loss of interest, you lose only that small amount in a debt mutual fund, which historically in the last 20 years hasn't happened more than once or twice for 0.5%, 2%, 3% at some point of time on some amount in some schemes. Very, very on 99.9% times, your money is more or less very, very safe. Choose the debt fund most suitable to you. Now, there are many schemes in debt mutual fund in which you can invest. It is not necessary that you have to invest only in a particular AMC with a particular thought process. I will give you an example. Let us say you want to invest for 2 days. We have a fund called overnight funds. It is absolutely safe. No exit load. Currently, in current situation, as I am speaking right now with you, and returns can change over a period of time. Currently, overnight funds are delivering around 4.25% even if you invest your money for 1 day. Liquid funds. If you have money for more than 7 days, liquid funds are best for you. Then you have ultra short-term funds, 3 months and above, low duration funds, short-term funds, medium-term funds. So depending upon your time horizon, your mutual fund distributor or advisor will suggest you exactly which fund is suitable for you and what kind of investments the underlying portfolio is having in those funds. You can choose between that. Currently, there are 7-8 categories of debt funds in which you can invest into. I will answer 3 questions that come in your mind, and then I will take 5 minutes of another presentation briefly, and I will hand it over to Shrest. The first question you will have is, there are no guarantees, Mr. Dalmia, in mutual funds or debt funds. You are absolutely right. The regulator SEBI doesn't allow mutual funds or any distributor or advisor to guarantee any returns because it is so powerful. It is your money and the entire returns are yours. You know, if, for example, when you invest in a bank fixed deposit, the bank makes 10%, but you get 5% maybe. Or if the bank makes 4%, you get still 5%. Whereas in mutual funds, if the company is making more money, you get more money. If the company is making less money, you get less money. Chances of getting less is not much if you see the historical track record. So while there are no guarantees, but the upside is also yours. Sometimes you can get 1%, 2% more than you expect in a debt mutual fund. So, and the beauty is that, and मैंने personally life में ये देखा है, जहाँ guarantees होती है, वहाँ growth नहीं होती. So you have to go for open ceiling. अगर ceiling closed है तो आप उतना ही ऊपर जा सकते हैं, लेकिन अगर ceiling open है, so you can go further in life beyond the ceiling, or your investments can grow beyond the barrier of the ceiling that you are investing in. So mutual funds में guarantee नहीं होती, लेकिन historical track record से returns काफी अच्छे होते हैं. Second question, some debt funds have given low returns. Absolutely right. And I'm taking the toughest questions that you can ask me. Some debt funds have given low returns. There are 1,000 schemes in mutual funds. And some of these schemes may not have given, maybe 5 or 10 schemes would have given you lower return. It will always happen in any industry. For that matter, some of the companies also default in which people do fixed deposits. Some of the banks also default in which you do fixed deposit. So you have to choose the right mutual fund company, the right mutual fund schemes, and you can get good returns. And even if some debt funds have given low return, it is only for 3 months, 6 months, and 1 year because of the government interference in the interest rate market of the country. If the interest rates go up, debt funds give you lower return. And if interest rates go down, futuristic returns on the same funds go down, but suddenly you get upside. So this is a concept which will take you 15 minutes to explain, which I will excuse myself here in the interest of time, but your mutual fund distributor can explain you the concept why debt funds have given low returns sometime in 3 months, 6 months period, but it is not always the case. For example, if you invested last 1 year, some of the funds have given you 3.5%, whereas bank might have given you 4.5%. So you got 1% lower. But if you continue your investment in the same scheme for the next 1 year, those schemes will deliver 5.5%, 6%, depending upon the type of funds you are investing in, whereas your bank FD will continue to offer you 5% only. So even if you get lower return, if you hold those investments for a long period of time, chances are your returns will be quite decent. Again, to give you the perspective of group tours versus self-tool, when you do your group tours, sometimes you lose your way, sometimes your cost is more, sometimes you miss out on some of the important places to see, but that's all right. With experience, you understand how to prepare for your next tour and how to make it more and more worthwhile. In the same way, when you start investing in debt fund, once in a while, you may have a little lesser experience than what you have expected, but over a period of time, you will do very well. Third question is that, currently returns of debt fund and a fixed deposit is almost similar. So why should I invest in a debt fund? Friends, it's not about today. It's not about 3 months. It's not about 3 years. It's about 30 years. The culture, the first point which I mentioned to you, it's about a cultural shift to understand and transfer yourself into a better financial product worldwide. In my opinion, almost all ultra HNIs keep their money in debt funds. If you see the top 500 companies in India who are listed on Bombay Stock Exchange or National Stock Exchange, maybe 400 of them have invested their money not in a fixed deposit, or even if they have fixed deposit, they have a lot of debt fund. And Shresh will confirm. Shresh is the right person to answer because he manages a large treasury portfolio of so many big corporates. Even these corporate houses like ITC or Reliance or Infosys, for that matter, invest in a debt fund. And if they are investing in debt fund, and they have option of fixed deposit, and they will get the best return in fixed deposit with the bank because of their relationship, still if they are going for debt fund, it's a case to invest in a debt fund, and there is reason why these people invest in debt fund. With that, I will say thank you, but please don't go away. I will share one more very short presentation, which will also be very, very useful to you, and this presentation is about how you can use your fixed deposits into a much better product which can give you better returns. Okay, so this is a unique investment idea I'm giving you, and your distributor will tell you more about this. This plan is called Systematic Transfer Plan. This is applicable in only mutual funds. This plan is suitable for investors looking for high safety of capital with potential of little higher returns in the long term. Very, very powerful. Let me give you the highlights, and then you decide whether you will like to know more about this plan or not. In this plan, when you invest your capital, there's a very high safety of capital. The potential of higher returns is there than fixed deposits. So returns could be better than fixed deposit. You pay lower taxes. You can withdraw your capital at any point of time. Your distributor will invest in a fund without any exit load. So if you invest today, you can withdraw at any point of time without any exit load. Minimum amount is as low as 5,000. Maximum amount, there is no limit. You can invest 5 crores also. After you have invested 10,000, 50,000, 5 lakh, 10 lakh, and if you like this product, you can top up investment in this scheme at any point of time. If you have any emergency use of fund, you can do partial withdrawal any point of time. So you invested 20 lakh rupees and suddenly you need 3 lakh rupees. You can call your distributor and ask for redemption. The money will be in your bank account in 1 working day. And there is no maturity date. Choose your own period. How does the plan work? The plan works like this, that you invest your principal in a debt fund. And this principal, whatever is the monthly appreciation of this plan, so you invest 20 lakh rupees just for the sake of illustration, if your monthly appreciation is 10,000 rupees or 12,000 rupees, this 10, 12,000 rupees will move from your debt fund into an equity scheme on a monthly basis. Your capital remains intact here. And only the appreciation amount is going into equity. So you don't take risk of equity market, share bazaar from a capital perspective. Because of this, I will give you a summary of an illustration. If you invest 25 lakh rupees in a debt fund or 10 lakhs or whatever you want to do, and you give your instructions that for 15 years, your expected return is, let's say, 5% or 12%. Again, I must tell you that in mutual funds, returns are not guaranteed. This is only for illustration purposes. Please do read mutual funds documents before investing. There's a standard disclaimer which I must give all of you. Expected future value, and this is expected future value generally. It is not related to any specific mutual fund. Your returns could be 73 lakh rupees total fund value, and the returns can go up to 7.41%. So you started at 5% return in a debt fund, but because of appreciation amount going into equity, which might get 12% return, your total portfolio return can go up to 7.4% without risking the capital component of your investment. And this is the flow. So you invest 25 lakhs in a debt fund and it remains 25 lakh rupees every year in the debt fund. You are not taking risk of equity here. Only the interest component, appreciation component is going into equity. And this interest component, appreciation component, because of equity fund averaging long period of time, better performance, your returns from 5% go up to 5.15, 6, 6.5, 7, and 7.5%. In the same manner, if you invest 10 lakh rupees and your debt fund return is 6% rather than 5%, then your return from 7.4% can go up to 8.247% in 15 years time with much better tax benefits, anytime liquidity, and virtually very, very, very less, of course, very high safety of capital. And this is the illustration again. And you should definitely ask your financial advisor, mutual fund distributor to know more about this product. This is called STP, and you should take advantage of this. 3 questions on STP, and then I will rest my case. Is my capital safe? I think yes. Capital amount will be invested in a pure debt fund. These debt funds do not have any equity exposure. Can I withdraw partial full investment amount at any point of time? Answer is yes. There's no questions asked. And your distributor will suggest your debt funds that will have no exit loads. So you can withdraw your investment portion at any point of time if you want. The income appreciation component of the capital investment should be held for longer period, as it will be equity oriented funds and may have exit loads. But your principal amount, you can withdraw at any point of time. And finally, tax advantage. Debt funds after 3 years will give you long-term capital gain advantage, and equity funds after 1 year will give you long-term capital advantage, which is very, very suitable and very, very powerful for you. How to start? Simple. You decide the investment amount, see how much FDs you have in a bank or a company deposit, when they are maturing, or can you do a partial withdrawal, closer or early closer? If yes, you can consider and call your distributor, and he will suggest you the scheme of debt fund for capital investment and a scheme of equity fund for income appreciation. Please contact your mutual fund distributors for more detail. With that, I will rest my case, and I have taken around 20-24 minutes. I will now invite, and you can ask the questions, you can write your questions in the Q&A box in the meantime, and I will invite Sresh to take it forward.
Sure. Thanks, Brajeshji. And Warm welcome to the entire audience, the investors and the MFDs on the call today. Thanks for logging in today. Quickly, given the HDFC AMC brand and pedigree, so we have a philosophy in our fixed income management, and that is what I'll just take a few minutes to share with you. So we work on a SLR philosophy. So wherein S stands for safety, L stands for liquidity, and R stands for return. And this is specific to the fixed income piece. So when we talk about safety in fixed income, we all know that safety is the prime most importance for the investor in terms of his principal amount. So that is what S stands for. L is basically for liquidity. Now, everybody is aware that in fixed income, liquidity is of prime most importance in the sense whenever we need money, the money should be available to us. So that is what L stands for. And lastly, while we all invest for returns, but that is what step 3 is, R stands for return. So while the endeavor is to get the best risk adjusted return, but at HDFC AMC, we try to follow the steps. The first is the safety, the second is the liquidity, and then comes the return. So that's the philosophy that our fixed income team follows in ensuring that the trust of the investors who are investing with HDFC brand, so that remains consistent. And the endeavor is in whichever scheme that you come. And as Brijesh ji mentioned, the investment time horizon can start from 1 day till as per your need. I think the idea is to give you that seamless experience. So that is what, Brijesh ji, I wanted to share because your presentation was elaborate. So maybe we can just quickly move on to the last Q&A session. Over to you, Brijesh ji.
Fantastic. Thank you so much, Shrest. And now we are open for Q&A. And as I can see, more than 500 people have logged in. And maybe some of the people logged in a little late early. And so maybe 600, 700 people all across the country have attended this event. Thank you so much. So we'll take your questions. We'll not take any microphone questions. And if you have any question, please write in the Q&A box or in the chat box. One question is that, will I get an educational loan or a loan from a bank if I invest in a debt fund? The answer is yes. The banks will give you a loan on mutual fund units can be pledged and you will get a loan on this. What are the disadvantages and risks in debt fund? Shrest, will you like to take this? Dr. Raman is asking this.
Yeah. So basically, it is more of a risk. So there are different type of risk in a fixed income fund. And I think apart from the credit risk, the main thing that from a fixed income investor perspective, we need to be cognizant is the interest rate risk and the reinvestment risk. So interest rate risk is key. As the interest rates move up, the return. So there is an inverse correlation between the bond and the interest rate. So maybe for a shorter, so just to give you a gist, so maybe for a shorter term perspective, you may see volatility in your portfolio. But if you stick to the time horizon, as Brijesh ji has shown that entire grid, so then it is most likely that you should not be worrying. So one risk is the interest rate risk. And the second is the reinvestment risk. Now the reinvestment risk, mainly you see from a fixed income traditional instrument. Now that risk moves out if you come into via mutual funds, because in mutual funds, you don't have to redeem your money till you need it. While in a fixed bank deposit or any other traditional instrument, there is a maturity. So it is a one year maturity or a 3-year maturity. So whenever you have to again renew that FD or your traditional instrument, so the returns in the market might have come down. So that is the reinvestment risk, which again mutual funds have a benefit that just because there is no maturity, you can just keep your money till you don't need it. So I think these are the 2-3 things that one should be cognizant about while investing into fixed income.
Right. Chetan Shah is saying, what about if we have a time horizon of 5 to 10 years and not 20 years? No problem. 5 to 10 years is also a very good long time horizon. You can invest in a debt fund. I will suggest you, of course, you should talk to your mutual fund distributor. You should consider systematic transfer plan. You should put your fixed amount into a debt fund. And from there, a fixed amount can be transferred to the equity fund without disturbing the capital. That should give you decent returns, I think, Chetan. Another question is, but debt funds are also subject to credit risk, right? Suraj M. Nair is asking, absolutely yes. But there are debt funds which are not subject to credit risk. You can go for gilt funds. Gilt funds means Government of India bonds. They invest 100% of your money only in a Government of India bond, and that are not subject to credit risk. Even in liquid funds, you can go, or overnight funds, they are not subject to credit risk, but you should invest in liquid or overnight fund only if your time horizon is 1 day, 5 day, 10 days kind of thing. Apart from that, credit risk is there, but if you're investing 1 lakh rupees, your 1 lakh is going into 20, 40, 60, 80 company. So essentially, if more than 2, 5 or 10 companies default, then there is a risk, which never happened in India. So technically, yes, practically, yes, theoretically, yes, theoretically, yes, but practically it doesn't happen. So Suraj, my sense is that I have been looking into debt funds for last 20 years, 99.9% of the time, they have managed credit really, really well. Akash, for more safety, ultra short and low duration funds are better. Yes. On medium duration and long duration. So all funds are good. But if you go for longer duration funds and interest rates volatility is there, then your short-term returns could be a little lower. Another question which is very interesting is that some of the debt funds have given only 2% return, only 2% return in the last 1 year. What do you have to say? So, friends, yes, out of 1,000 schemes, there are certain funds which did not do well in the last 1 year, but it is not because they did not manage the funds well. Government of India or the general market dynamics, interest rates went up suddenly because of the Russia war, petrol prices, inflation in US, and Federal Reserve in America increasing the interest rate. Now, what happens? And I will take 30 seconds to explain you this concept. If you make 10 lakh rupees fixed deposit in State Bank of India on 1st of January for 1 year, and you get 6% return, and the next day, State Bank of India offers 12% return. Your friend has to deposit 1 lakh rupees FD in State Bank of India, and you need the money. You say, friend, why don't you take my FD and give me 1 lakh rupees? Your friend will not take your FD because on that FD, he will get 6,000 rupees interest. Whereas if he makes a fresh investment of FD in State Bank of India, he will get 12,000 rupees of interest. So he will say, if you offer me your investment at 94 rupees, so I will get 6,000 on maturity benefit and 6,000 interest from State Bank of India. My returns are 12%. In that case, you lose 6% of your capital amount. This is a raw example I'm giving you because interest rates suddenly go up. You might lose some bit of your principal amount or your interest component because of which the returns go down. But this doesn't happen always. Sometimes you get benefit also. And then like equity mutual funds that, sometimes when the markets go down, your investments can go down. So in the same manner, when you're investing in the financial markets, some investment, some product might give you lower return at some point of time. As I said, one of your trips which you organize on your own may not do very well and you may fall ill and there may be some issues regarding going to a nice place, but you learn from it and the next time you prepare for it better. It doesn't mean that you will never travel on your own. So if some debt fund performance is not very nice, you can always learn from that experience and understand and do not repeat it. So that's my answer. I hope I have been able to.
Somebody is asking whether we can do a top up or we can put additional amount in a mutual fund debt scheme. The answer is yes. You can put additional amount. You can redeem also partial amount. It is not that you have to redeem the full amount. It is all flexible as per your need.
Nishant Parekh is saying, what happened to one mutual? I will not name any mutual fund. Some of the mutual fund schemes defaulted in Divan Housing or maybe ILFS or maybe Z or Reliance. You see, these are called accidents. In the COVID crisis, a lot of things happened. These are accidents, and accidents can happen anywhere. Banks also default. Yes Bank also defaulted. So friends, in a financial market or life, we are today alive, tomorrow we may not be. So these are called accidents. These are not day-to-day process. When you fly by air, once in a while, one of the aircraft can land into accident. It doesn't mean that you stop flying. Yeah, there is some risk. When you fly, there is a risk that whether you will land or not, but most of the time you do land. Even if there is a turbulence in the aircraft, you don't get out of the aircraft because there is a turbulence. 99.99% you will land safe. In the same manner, some of the time, some of the schemes, when you invest in, there are certain losses. So you should diversify your investment. You should not put 10 lakh rupees, one investment, only one investment in one mutual fund into one scheme. You should have one or two mutual funds, two or three mutual fund schemes. So you diversify. And then you have further diversification of 100 schemes. So even if you lose, you might lose 1% or 2% of your capital, not more than that. Okay. There are many questions. So if you are not able to take some of the questions, please excuse us, but we are trying to see the last question. So if your questions have gone above and we are not able to scroll up, you please cut and paste those questions at the bottom. Okay. Let me check. In case one has opted for monthly interest, Debashish is asking, monthly interest FD, what is the option we have in debt fund? Yes, you have something called systematic withdrawal plan option in debt funds. So if you invest, let's say 10 lakh or 20 lakh or 50 lakh, whatever, and you want monthly returns back in your bank account, it is possible. Please ask your mutual fund distributor for more details. Please explain taxation part of arbitrage and debt fund, Mansi Anekar. It's a long answer, but I'll try to give a very short answer. If you hold debt fund for 3 years, you get long-term capital gains advantage. Arbitrage fund qualify for equity taxation because of the structure of the fund. And so you get long-term capital gains benefit after 1 year, and the tax is only 10%. So if your horizon is 1 year, arbitrage fund could be a better tax preferred vehicle. How about choosing an arbitrage fund? Why Manoj is saying, how about choosing an arbitrage fund, which is tax efficient compared to debt fund? Yes. But then again, currently, you have to see what is the return of an arbitrage fund. If the return of arbitrage fund is lower by 1.5%, 2% than a debt fund, then it doesn't make sense. If the return of arbitrage fund is 0.5%, 1% lower than debt fund, then tax advantage can be beneficial. So your mutual fund distributor will do this analysis that after paying taxes, you are better off in arbitrage fund or debt fund. But debt fund definitely, sorry, arbitrage fund definitely is a good option. Okay. Can I keep investing in debt fund for long time through SIP? Ram Bhuvan is asking. Yes, the answer is yes, you can. Chavan is asking, SIP, EMI and home loan EMI, which is good? Home loan EMI is not bad. The only good loan that you can take is home loan because you get interest benefit and the interest rates are very, very low. The second best option is SIP. And if you have a home loan, I strongly suggest you to think about how you can add some SIP on your home loan and you can recover your entire principal and interest component. Fantastic. GC is asking, why not park lump sum in an arbitrage fund and do STP from there in equity fund? Yes, it can be more beneficially for the first 3 years. After that, more or less, it's the same. And see, there are hundreds and thousands of permutation and combination. So, and that's the power of debt funds. That's the power of mutual funds. NRE amounts, Kavita is asking, Kavita S. Ramchandani is asking, NRE amounts invested in mutual funds remain in NRE status? Yes. Ketan Acharya is saying, give regards to Shrestha. Okay.
Thanks.
Which is the best debt fund? Uday is asking. There's nothing called best debt funds. It's all about how long you want to invest. If you want to invest for 2 days, overnight are best funds. If you want to invest for 10 years, today in current situation, government securities funds can be the best because they offer you the safest with the one of the highest returns because interest rates have gone up. So it depends upon which time period you are looking at. Can we increase, Umesh is asking, Umesh Kekwad, can we increase capital after some years if we have another amount? Yes, of course, anytime. Some Q&A questions, if I can check. We will close the webinar in the next 2 minutes as promised so that you can carry on with your other activities on a Sunday afternoon. Okay, a couple of more questions. Sebastian, the long-term return of low duration floating rate fund is around 6.5%. If somebody wants to invest for more than 5 years, is it idle to invest only in low duration? No. If your time horizon is more than 5 years, low duration and floating rate fund may not be the best. You should go for a longer duration funds like gilt funds or credit risk fund or banking and PSU debt funds, which might give you better returns over 5-year period. Of course, in these funds, the volatility will be more in the 1-year period. But if you invest in a low duration fund for 5 years, I do not suggest that at all. Can you compare IPO with MF? Muhammad Iqbal. Well, this is a debt fund program, but very shortly I will answer you that mutual funds are safer. What would be the typical time horizon if I have to invest into gilt funds? 3 to 5 years, Manoj. Do you foresee risk in debt funds similar to what happened in one of the mutual fund schemes a few years back? Well, theoretically, the answer is yes. Practically, my answer is no, because a lot of risk management has improved over the last 2 years. And that was a classic case of COVID-induced liquidity crisis because of which that event happened. Dr. Archana is asking how to know which mutual fund is good. I will give you a very crisp answer about this. The first thing that you should do is to know which brand you are going after. If the brand you know, the first selection has to be on the basis of brand. For example, जब आप कोई shopping करने जाते हैं, तो you look for the brand because that brand has done well in the past. There's no guarantee of the future, but you take decision based on your past experiences. Okay, so the past experience says that this brand I relate myself with, this brand I relate myself with. So the first choice is that which brand out of 42, 45 companies in mutual funds you believe in. The second choice is that is the scheme I am trying to invest has a track record of 2, 3, 5, 10, 15 years or not. These are the first two parameters you should look at. And there are no one answer again into this, but to give you a short answer, these are my way of looking into fund. Viren Bhatt, idle period of holding gilt funds, 3 years, 5 years. All right, I think most of the questions we have answered, and we try to keep our events very, very short so that you enjoy the event very, very crisp. And if you want to join more events done by me, I do these events every month. So you can get in touch with your mutual fund distributor for other ideas on various investors meet that we keep on organizing. Thank you so much, all the mutual fund distributor partners who have invited your investors, all the investors who have joined this program, and to SDFC and Shrest, who was there to explain some of the concepts of debt fund. Any final words from you, Shrest?
Yeah. Thank you once again. Thank you, Brijesh. Thanks to the entire investors and MFDs for logging in today. It was a pleasure interacting with you and look forward to see you soon. Thank you.
Thank you, everybody. Take care.
Yeah.
Enjoy.
Bye-bye.
Bye-bye.